Question 1. Scenario-based. Mr. Yoshida is the chief underwriting officer at an insurance company in Hawaii. His company has experienced significant losses from wildfires and wants to reduce its exposure by entering a proportional reinsurance agreement. The reinsurer offers to take 60% of both premiums and claims in exchange for a proportional share of the risk. What type of reinsurance arrangement is Mr. Yoshida considering? A. Quota share treaty. B. Excessive loss treaty. C. Stop loss reinsurance. D. Facultative reinsurance. Answer A. Explanation. A quota share treaty is a proportional reinsurance agreement where the reinsurer assumes a fixed percentage of both premiums and claims. In this case, the reinsurer is taking 60% of the risk, which is a classic example of quota share reinsurance. This arrangement is commonly used to reduce the insurer's exposure to large losses while maintaining steady income from premiums. Excessive loss reinsurance. Option B. Non-proportional arrangement where the reinsurer covers losses exceeding set limit. Stop loss reinsurance. Option C caps the insurer's total annual losses, and facultative reinsurance. Option D applies to individual risks, not entire portfolios. According to the Hawaii Insurance Code HRA 4131, insurers must ensure they have adequate reinsurance programs to manage risk, particularly in disaster-prone areas like Hawaii. Question 2. Which of the following best describes the purpose of retrocession in reinsurance? A. It transfers the risk from the policyholder to the insurer. B. It allows a reinsurer to further transfer its assumed risks to another reinsurer. C. It is used to terminate a reinsurance contract early. D. It ensures the reinsurer retains 100% of the ceded risk. Answer B. Explanation. Retrocession refers to a situation where a reinsurer transfers part of the risk it has assumed to another reinsurer. The original insurer is referred to as the cedent, the first reinsurer as the retrocedent, and the second reinsurer as the retrocessionaire. This practice helps reinsurers manage their exposure and avoid overconcentration of risks. Option. It describes the primary insurance process, not retrocession. Option C is incorrect because retrocession is not used to terminate contracts, and D is incorrect because retrocession involves sharing risk, not retaining all of it. Hawaii's regulatory framework encourages retrocession to spread risk across multiple entities, as outlined in HRAS 3212. Question 3. Under Hawaii law, which of the following is a requirement for a reinsurer to be considered an authorized reinsurer in the state? A. The reinsurer must have its principal office located in Hawaii. B. The reinsurer must be licensed in Hawaii and maintain minimum capital requirements. C. The reinsurer must offer both proportional and non-proportional reinsurance contracts. D. The reinsurer must have a local claims settlement office in Hawaii. Answer B. Explanation. To be considered an authorized reinsurer in Hawaii, a company must be licensed in the state and meet the minimum capital and surplus requirements set by the Hawaii Department of Commerce and Consumer Affairs. This ensures that the reinsurer has the financial stability to meet its obligations. Option is incorrect because the principal office does not need to be in Hawaii. Option C is incorrect as there is no requirement to offer both types of reinsurance. Option D is incorrect because local claims offices are not mandated by law. The relevant regulations are found in HRAS 8301 to SS 8310. Question 4. Which of the following is a key consideration for a reinsurer when pricing an excessive loss reinsurance contract? A. The number of policies covered by the insurer. B. The insurer's historical loss frequency and severity. C. The insurer's marketing strategy. D. The reinsurer's administrative costs. Answer B. Explanation. When pricing an excessive loss reinsurance contract, a reinsurer primarily considers the loss frequency and severity of the insurer's historical claims data. This helps the reinsurer assess the likelihood of catastrophic losses and price the contract accordingly. Options and C are less relevant to the pricing process. Option D is factor, but it is secondary to loss. HISTA HRA 4127 outlines the need for reinsurers to use sound actuarial principles when pricing contracts. Question 5. In a reinsurance contract, what is the purpose of a loss corridor clause? A. It limits the reinsurer's liability to fixed amount per claim. B. It requires the insurer to retain portion of the risk within specified loss range. C. It allows the insurer to terminate the contract if claims exceed certain threshold. D. It guarantees that the reinsurer will pay all losses above set retention limit. Answer B. Explanation. A loss corridor clause requires the cedent insurer to retain a portion of the risk within a specified range of losses even after the reinsurer's retention limit is reached. This helps align the interests of both parties and ensures the insurer has continued stake in controlling claims. Option describes per claim limits in excess of loss contracts. Option C is incorrect because loss corridors do not involve termination. Option D incorrectly implies the reinsurer covers all excess losses without limits. The use of loss corridors is best practice recommended by Hawaii's reinsurance guidelines. Question 6. Which type of reinsurance would be most appropriate for an insurer looking to protect itself from a sharp increase in claim frequency across its entire portfolio? A. Excessive loss reinsurance. B. Stop loss reinsurance. C. Quota share reinsurance. D. Facultative reinsurance. Answer B. Explanation. Stop loss reinsurance protects the insurer from aggregate losses exceeding a specified amount over a given period, regardless of the number of claims. This is ideal when an insurer is worried about a high frequency of claims. Excessive loss reinsurance, option A, focuses on individual large claims, not claim frequency. Quota share, option C, and facultative reinsurance, option D, are more relevant. Individual risks or proportional sharing of all risks. Question 7. Which of the following best describes the role of a reinsurer's claims control clause in reinsurance contract? A. It requires the reinsurer to directly handle all claims. B. It gives the reinsurer the right to participate in claims management decisions. C. It obligates the insurer to settle all claims without reinsurer input. D. It caps the amount the reinsurer will pay for each claim. Answer B. Explanation. A claims control clause gives the reinsurer the right to participate in or oversee the management of claims that could result in significant payouts under the reinsurance contract. This protects the reinsurer's interests and ensures that claims are handled appropriately. Option is incorrect because reinsurers typically do not handle claims directly. Option C contradicts the purpose of the clause, and D describes claims cap, not claims control clause. The Hawaii Insurance Co. HRAF 135 recognizes the importance of claims control clauses in facultative and excessive loss treaties. Question 8. In a stop-loss reinsurance contract, what is the primary function of the attachment point? A. It determines the reinsurer's share of the premium. B. It specifies the maximum liability of the reinsurer. C. It sets the loss level at which the reinsurer begins to cover losses. D. It dictates the reinsurer's role in claims management. Answer C. Explanation. The attachment point in stop-loss reinsurance is the threshold above which the reinsurer becomes responsible for covering the insurer's losses. Options A, B, and D are unrelated to the function of the attachment point. Question 9. Which of the following types of reinsurance is most suitable for a small insurer looking to protect against a large single claim event? A. Quota share reinsurance. B. Facultative reinsurance. C. Stop-loss reinsurance. D. Excessive loss reinsurance. Answer D. Explanation. Excessive loss reinsurance is ideal for protecting insurers from large single claim events by covering losses that exceed a specified threshold. Small insurers benefit from this protection to manage potential catastrophic claims. Quota share reinsurance, option A, is proportional. Facultative reinsurance, option B, applies to specific risks, and stop-loss reinsurance, option C, covers aggregate losses within a... Question 10. Under Hawaii law, what is the minimum capital requirement for a reinsurer to be authorized to operate in the state? A. $2.5 million. B. $5 million. C. $10 million. D. $15 million. Answer B. Explanation. Hawaii requires reinsurers to maintain a minimum capital of $5 million to ensure they have adequate financial backing to cover potential claims. This is outlined in Hawaii Revised Statutes 8 RSS 4104. Question 11. Scenario-based. Mr. Nakamura, an insurer in Hawaii, is negotiating a treaty reinsurance contract with a reinsurer. The contract includes a provision that the reinsurer must accept all risks within the specified portfolio regardless of individual risk characteristics. What type of treaty reinsurance is this? A. Facultative reinsurance. B. Proportional treaty reinsurance. C. Automatic treaty reinsurance. D. Non-proportional treaty reinsurance. Answer C. Explanation. An automatic treaty reinsurance requires the reinsurer to accept all risks that fall within the agreement's terms without the need for individual underwriting. This is typically used to streamline the reinsurance process for large portfolios. Facultative reinsurance, option A, is for individual risks. Proportional, option B, and non-proportional, option D, refer to how losses and premiums are shared. Question 12. In a surplus share reinsurance arrangement, how are premiums and losses divided between the insurer and the reinsurer? A. Proportionally based on a fixed percentage of all policies. B. Based on the reinsurer covering only the high-value portion of each policy. C. Equally shared between the insurer and reinsurer. D. According to the number of claims filed. Answer. B. Explanation. In surplus share reinsurance, the reinsurer covers only the portion of each policy that exceeds the insurer's retention limit. This allows the insurer to retain smaller risks while transferring higher value risks to the reinsurer. Question 13. Which of the following best defines the term cedent in reinsurance? A. The primary policyholder. B. The company assuming the risk. C. The company transferring the risk. D. The reinsurer handling claims. Answer. C. Explanation. The cedent is the insurance company that transfers risk to a reinsurer. This is a key term in reinsurance contracts. The reinsurer is the party assuming the risk, while the primary policyholder is unrelated to the term. Question 14. What is the primary purpose of a loss corridor provision in non-proportional reinsurance contract? A. To limit the reinsurer's liability to a specific range of losses. B. To increase the reinsurer's premium share in profitable years. C. To ensure the reinsurer covers all losses beyond the attachment point. D. To reduce the insurer's retention limit. Answer. A. Explanation. A loss corridor is a provision that limits the reinsurer's liability to a specific range of losses. Once losses exceed that range, the insurer may resume responsibility for covering additional losses. Question 15. Which of the following risk assessment techniques is commonly used by reinsurers to estimate the impact of catastrophic events? A. Actuarial modeling. B. Scenario planning. C. Risk pooling. D. Catastrophe modeling. Answer. D. Explanation. Catastrophe modeling is a key risk assessment technique that simulates potential catastrophic events and estimates their financial impact on insurers and reinsurers. While actuarial modeling, option A, involves risk prediction, scenario planning, option B is broader and risk pooling, option C refers to spreading risks. Question 16. Which regulatory body oversees reinsurance activities in Hawaii? A. National Association of Insurance Commissioners (NAIC). B. Federal Insurance Office (FIO). C. Hawaii Department of Commerce and Consumer Affairs (DCA). D. Reinsurance Regulatory Board (ARA). Answer. C. Explanation. The Hawaii Department of Commerce and Consumer Affairs (DCA) regulates reinsurance activities within the state. The NAIC provides guidelines, but state regulators like the DCA enforce compliance. Question 17. Which factor is typically considered when pricing a reinsurance contract? A. The insurer's financial statements. B. The geographic location of the reinsurer's headquarters. C. The claims history of the cedent. D. The reinsurer's marketing budget. Answer. C. Explanation. When pricing a reinsurance contract, claims history is a critical factor. It helps the reinsurer assess risk exposure and set appropriate premium rates. Question 18. Which of the following innovations has significantly impacted the reinsurance industry in recent years? A. Manual claims processing. B. Blockchain technology. C. Paper-based contracts. D. Regional pricing adjustments. Answer. B. Explanation. Blockchain technology has revolutionized the reinsurance industry by enhancing transparency, security, and efficiency in contract management and claims processing. Question 19. Which of the following strategies helps reinsurers manage their exposure to high-risk portfolios? A. Increasing premium rates across all policies. B. Utilizing retrocession. C. Reducing the number of claims adjusters. D. Investing in low-risk securities. Answer. B. Explanation. Retrocession allows reinsurers to transfer part of their risk to another reinsurer, effectively managing their exposure to high-risk portfolios. Question 20. What is the key difference between finite reinsurance and traditional reinsurance? A. Finite reinsurance focuses on risk transfer only. B. Traditional reinsurance covers both risk transfer and financial support. C. Finite reinsurance has a shorter duration and limited risk transfer. D. Traditional reinsurance does not involve risk assessment. Answer. C. Explanation. Finite reinsurance typically involves shorter durations and limited risk transfer, with an emphasis on financial support and capital management rather than extensive risk transfer. Question 21. Which of the following best describes the primary difference between proportional and non-proportional reinsurance contracts? A. Proportional contracts transfer only catastrophic risks, while non-proportional contracts cover all claims. B. Proportional contracts involve sharing both premiums and losses, while non-proportional contracts cover losses only beyond a set threshold. C. Non-proportional contracts are always cheaper for insurers than proportional contracts. D. Proportional contracts allow the insurer to retain full claims control, where non-proportional contracts do not. Answer. B. Explanation. In proportional reinsurance, the reinsurer shares both premiums and losses with the cedant based on a predetermined percentage. In contrast, non-proportional reinsurance only covers losses that exceed a specified threshold, making it ideal for catastrophic protection. The choice between these depends on the insurer's risk tolerance and portfolio. Question 22. Under Hawaii law, which of the following is a requirement for an offshore reinsurer to be recognized as an authorized reinsurer in the state? A. The reinsurer must have a minimum credit rating of B. B. The reinsurer must have a physical office in Hawaii. C. The reinsurer must post collateral in the form of cash or securities. D. The reinsurer must limit its business to life insurance policies. Answer. C. Explanation. Hawaii law requires offshore reinsurers to post collateral, such as cash or securities, to be recognized as authorized reinsurers. This ensures that the reinsurer has sufficient assets to cover potential claims. Collateral requirements are typically outlined under NAIC guidelines and adopted by Hawaii's Department of Commerce and Consumer Affairs (ISI). Question 23. Scenario-based MS Takahashi, an underwriter at a Hawaiian insurance company, is reviewing a facultative reinsurance proposal for a commercial property policy in a high-risk flood zone. The reinsurer is willing to provide coverage, but only for a portion of the building's value. What type of reinsurance arrangement is this? A. Quota share reinsurance. B. Surplus share reinsurance. C. Facultative reinsurance. D. Excessive loss reinsurance. Answer. C. Explanation. Facultative reinsurance involves individual risk evaluation by the reinsurer. In this case, the reinsurer is agreeing to cover a specific commercial property, but only for a portion of the risk. This is different from treaty reinsurance, where a whole portfolio of risks is covered automatically. Question 24. Which of the following is the primary purpose of retrocession in reinsurance? A. To transfer risk from the policyholder to the reinsurer. B. To reduce the reinsurer's liability by transferring part of the risk to another reinsurer. C. To allow the cedant to retain more premium income. D. To facilitate faster claims processing. Answer. B. Explanation. Retrocession occurs when a reinsurer transfers part of its assumed risk to another reinsurer. This helps reinsurers manage their exposure to large claims and spread their risk portfolio more effectively. It is an important risk management strategy in the global reinsurance market. Question 25. In a stop-loss reinsurance arrangement, what triggers the reinsurer's liability? A. When the insurer's aggregate losses exceed pre-agreed percentage of total premium income. B. When single claim exceeds specified amount. C. When an insured peril occurs. D. When the reinsurer agrees to the terms of the contract. Answer A. Explanation. In stop-loss reinsurance, the reinsurer covers aggregate losses that exceed a pre-agreed percentage of the cedant's total premium income during a specified period. This type of non-proportional reinsurance is typically used to protect against high cumulative losses rather than individual claims. Question 26. Which of the following is a key factor considered by reinsurers when determining the pricing of a treaty reinsurance contract? A. The insurer's total number of employees. B. The reinsurer's marketing expenses. C. The insurer's historical claims data and risk exposure. D. The reinsurer's geographic location. Answer. C. Explanation. Historical claims data and risk exposure are critical factors that reinsurers analyze when pricing treaty reinsurance contracts. Understanding the insurer's loss history and risk profile helps the reinsurer determine an appropriate premium. Question 27. In Hawaii, what is the primary regulatory framework governing reinsurance transactions? A. The Federal Insurance Act. B. The Hawaii Captive Insurance Act. C. The Hawaii Insurance Code. D. The Reinsurance Reform Act. Answer. C. Explanation. The Hawaii Insurance Code governs reinsurance transactions in the state. It outlines licensing, collateral requirements, and reporting obligations for both domestic and foreign reinsurers operating in Hawaii. Question 28. Which of the following clauses in a reinsurance contract defines the maximum liability of the reinsurer for a specific claim? A. Retention clause. B. Claims control clause. C. Reinstatement clause. D. Limit clause. Answer. D. Explanation. The limit clause in a reinsurance contract specifies the maximum liability that the reinsurer is responsible for regarding a specific claim or series of claims. This protects the reinsurer from unlimited liability. Question 29. Which risk management strategy is most commonly used by Hawaiian reinsurers to mitigate exposure to catastrophic events such as hurricanes? A. Risk diversification across multiple states. B. Reducing the number of policies written. C. Increasing premium rates for all policyholders. D. Applying quota share reinsurance. Answer. A. Explanation. Hawaiian reinsurers often use risk diversification across multiple states to reduce exposure to catastrophic events such as hurricanes. This ensures that a single catastrophic event does not disproportionately impact the reinsurer. Question 30. What is the primary benefit of using a reinstatement provision in an excess of loss reinsurance contract? A. It allows the reinsurer to cancel the contract at any time. B. It enables the insurer to restore coverage after a loss for an additional premium. C. It guarantees full payment of claims without conditions. D. It reduces the insurer's premium for the next policy period. Answer. B. Explanation. A reinstatement provision allows the insurer to restore coverage after a loss by paying an additional premium. This is particularly important in excess of loss reinsurance where a single large claim could deplete the original coverage limit.